In the face of a challenging business environment, China's stock market stands precariously at the epicenter of intensifying geopolitical storms. Key factors like Beijing's widespread espionage clampdown, regular military exercises in the Taiwan Strait, the Western countries' push for economic decoupling from China, and technology sanctions have collectively driven foreign investors to withdraw from China, seemingly at any cost. A report released on September 19th by the Shanghai-based American Chamber of Commerce in China, AmCham, stated that U.S. firms' confidence in China is plummeting. 40% of U.S. businesses are either planning or have already begun shifting their investments away from China to other nations, a 6% increase from the previous year, with Southeast Asia emerging as a top alternative destination. On the same day, the European Union Chambers of Commerce in China, representing approximately 1,700 EU businesses operating in China, revealed that 50% of the European companies feel there are barriers to doing business in China. 62% claim they are missing out on opportunities, while 11% are relocating their existing Chinese investments to other countries. German experts have highlighted that the vast majority of European businesses in China are invested in the real economy sector, which is non-financial, making their exit from Chinese market particularly costly. However, given China's sluggish economic growth and worsening political climate, these companies appear resolute in their decision to divest. Both the European Union and U.S. Chambers of Commerce have issued warnings, signaling that democratic nations are uniting in their stance against China, potentially leading China's economy into a bleak winter. On her visit to Beijing on September 18th, Vice President of the European Commission, Vera Jourova expressed concerns over the opacity of China's legal system, exacerbating foreign firms' anxieties. One recurring concern she had from European businesses in China was the unpredictability in regulatory decisions and legal interpretations. Economic analysts have observed a grave trend of foreign capital flight from China. On one hand, factors such as the US-China decoupling, geopolitical tensions, and global supply chain shifts have prompted major foreign investors from regions like Europe, Japan, and South Korea to exit China. On the other hand, crises in China's real estate and financial sectors have prompted increased caution among potential foreign investors, especially since the COVID-19 outbreak, and enthusiasm of Chinese investments have continuously declined. Political commentator Li Ang commented on Radio Free Asia on September 20th that given China's political trajectory, the withdrawal of foreign investment is inevitable. The collapse of China's economy is unavoidable. All foreign investments will eventually leave. It's just a matter of time. China will revert to its isolationist policies and planned economy. The widening geological gap between China and the West is becoming ever more apparent. Earlier, Chinese financial scholar He Jianbing had pessimistically predicted a significant shift in foreign corporate supply chain away from China. In an interview on September 20th, he criticized Xi Jinping's erratic leadership for eroding the sense of security among foreign firms in China, anticipating that their departure could spike China's unemployment rates. Commenting on the situation, He Jianbing remarked, "Once you let go, massive transition occur. It's not about the pandemic, but the constant flip-flopping in policies and unpredictable decisions. Who can tolerate that? The excessive focus on security inflicts severe economic harm. As European chambers pointed out, what exactly constitutes a threat to national security? Without clarity, you'll just scare business away, leading to job losses." The Chinese Communist Party's new counter-espionage law, effective from July 1st, expands the enforcement powers of national security agencies and grants the government augmented search and exit entry ban capabilities, causing anxiety among many businesses in China. Japanese sociologist and China researcher at the University of Tokyo, Ako Tomoko, recently disclosed to the media that following the revision of the counter-espionage law, many Japanese scholars, students, and businessmen are now reluctant to set foot in China, fearing they might become a diplomatic hostage. According to Japanese media reports, since the introduction of China's counter-espionage law in 2014, 17 Japanese citizens have been detained, with one reportedly dying in custody. Scrutinizing Japanese media over the past 7 years revealed that the highest number of detention occurred between 2016 and 2018. Surprisingly, those with closer ties to the CCP appear to be at greater risk. In March this year, a senior employee at the China branch of Japan's Astellas Pharma Group was arrested. Based in Beijing, Astellas Pharma China is one of the largest Japanese pharmaceutical investment in the country. Headquartered in Tokyo, Astellas Pharma Group was established in April 2005 and is Japan's second largest prescription drug manufacturer. The Japanese government responded with great concern to this arrest, with their embassy in China strongly demanding the release of the citizen. On September 21st, Chinese Foreign Ministry spokesperson Mao Ning stated this Japanese national is suspected of espionage, violating the criminal law and counter-espionage law of China, and has been subjected to criminal coercive measures by the relevant Chinese authorities. Professor Ako Tomoko revealed that the detained businessman was her friend, who had been doing business in China for 2 decades with extensive connections. Many of his academic peers were shocked by his arrest, stating they would now hesitate to visit China. This July, 2 Japanese men were tried behind closed doors under the counter-espionage law, receiving sentences of 12 and 5 years respectively. Details about the detainees' professions and specific charges were not disclosed by Japan Ministry of Foreign Affairs. Professor Ako Tomoko said that the following recent changes to China's counter-espionage law, even Japanese scholars and students uninvolved in political studies, such as those studying Chinese at the University of Tokyo, have become wary of visiting China. Now, Japanese scholars, well-connected businessmen in China, and independent journalists are all seen as high-risk groups. Accusations under the counter-espionage law have frequently been made, leading to suspicions of diplomatic hostage-taking, especially as Japan-US military, economic, and technological exchanges intensify. In April, Japan's Center of Information on Security Trade Control, CISTEC, warned companies related to AI and semiconductors to be cautious of the counter-espionage law. With Japanese nationals being arbitrarily detained, Japanese businesses operating in China are growing fearful. As a result, the Japanese government has set a fund to provide grants to assist businesses looking to exit China. Numerous companies are opting to leave China and invest back in Japan. A report from Japanese media, Nikkei, on September 22nd highlighted that 1,670 Japanese firms that had established in China applied for relocation grants, a figure that is a staggering 11 times over the planned budget. Compared to the initial 90 businesses that applied in the first round in July, the second round witnessed a massive surge in applications, with the potential grant totaling reaching 1.76 trillion yen if all were approved. Nikkei pointed out that due to rising labor costs, the appeal of setting up factories in China has greatly diminished. Coupled with growing tensions between China and the US, many Japanese companies are determined to leave China, even without subsidies. The report also stated that the deadline for the second round of applications has passed, and external experts review and select the subsidy recipients in October. Given the large number of Japanese companies wanting to withdraw, Nikkei even described the situation as Japanese businesses lining up to abandon China. In July this year, the types of Japanese companies that received subsidies spanned across various sectors, including electronic instruments, aviation parts, automotive components, fertilizers, pharmaceuticals, paper making, information technology, optics, and raw material processing. Notable companies among them include Sharp, homewares manufacturer Iris Yoyama, pharmaceutical company Shionogi, medical equipment company Terumo, chemical manufacturing company Taneka, Shin-Etsu, and Sumitomo. One industry insider mentioned to Nikkei, even without the government subsidy, we have decided to leave China. In the first half of this year, foreign investments began pulling out of China rapidly. Market data indicates foreign holdings in China's stock and debt decreased by about 1.37 trillion yuan. That is 188 billion US dollars. A reduction of approximately 17%. This comes even before China's stock market experienced a historic 12 billion US dollar outflow in August. Capital flight from China is closely associated with its prolonged economic downturn, due to years of stringent zero-COVID measures, a housing market crisis, and continuous tensions with the West. A recent survey by the Bank of America revealed that these concerns have made avoiding China one of the most steadfast themes for investors. Moreover, since the end of 2020, offshore investors' participation in the Hong Kong stock market has declined by over a third. Chen Zikai, head of Asia and global emerging stock markets at BNP Paribas Asset Management, pointed out, foreigners can only acknowledge their losses. He noted that investors are apprehensive about China's housing market and the drop in consumer spending. Such disappointments are prompting many foreign investors to reassess their investment risk in China. Gaurav Pantekar, Chief Investment Officer at Merced Serra, which manages approximately $1.1 billion in US assets, stated that China faces multiple risks. These include local government financing platforms, housing inventory surplus, demographic structure, regulatory fluctuations, and geopolitical isolation. The depreciation of the yuan is also driving foreign capital to dump China's stock and bond assets. Given China's vast economic scale and its crucial role in the manufacturing supply chain, many investment institutions no longer see it as a vital part of their portfolio, with its investments' weight gradually decreasing. On September 7th, the world's largest sovereign wealth fund, the Norway Sovereign Wealth Fund, announced the closure of its Shanghai office, which had been in operation for nearly 16 years. They have now fully relocated their regional operations to Singapore. Market analysts suggest that below expected investment returns in China played a significant role in the fund's decision to exit. As one of the world's largest sovereign funds, the Norway Sovereign Wealth Fund has investments spread across 9,228 companies in 70 countries and regions and forms part of Norway's public pension system. It's not just the Norway Sovereign Wealth Fund making such decisions. On September 5th, BlackRock announced that due to a lack of interest from new investors, its China Flexible Equity Fund will be liquidated on November 7, 2023. Additionally, in June, CDPQ, Canada's second-largest pension fund, mentioned shutting down its Shanghai office. Tracing back to the origins of this economic downturn, it began with the US-China trade war during the Trump era, followed by 3 years of the pandemic during which Xi Jinping's administration implemented strict elimination policies that severely impacted China's economy. This was coupled with global raw material costs surging, the US hiking up interest rate, leading to a stronger embrace of the dollar, and current President Biden imposing sanctions on China's semiconductor industry. These factors are driving foreign capital out of China. At the same time, many Chinese companies which had aggressively borrowed to expand in the past are struggling to absorb the rise in raw material costs during their deleveraging process, resulting in frequent defaults and closures. Chinese financial analysts suggest that as foreign investment retreat, with more likely to follow in a cascading manner, a pattern might emerge that's difficult to overturn. This could lead to a drought in the infusion of new technology and sophisticated managerial insights. Should this trend persist, China's triad of growth drivers, investment, consumption, and foreign trade may falter, casting a shadow over the nation's prospects for the next 2 decades.